Are you unknowingly leaving hundreds of thousands of dollars on the table just by choosing the wrong growth ETF? In a real, long-term dollar cost averaging scenario, the difference between two popular funds was a staggering $103,000, all because of concentration and cost. The growth fund everyone is talking about might actually be the riskier, less efficient bet for your financial future. Today, we're finally breaking down why I added SCHG, the Schwab US Large Cap Growth ETF, to my portfolio. We'll explore what makes this growth monster fundamentally different from household names like QQQ and VGT. Most investors never look past the biggest tickers, and that familiarity often leads to costly, long-term mistakes. Before we dive into the data, if you want clear, actionable financial insights that cut through the market noise, make sure to subscribe to the channel right now and turn on notifications. The first silent killer of returns is cost. SCHG boasts an ultra-low expense ratio of just 0.04%. Compare that to QQQ's 0.20%, a difference that is 5 times higher annually. Over decades of compounding, that fee gap is like running a marathon with extra weight. It quietly chips away at your wealth. But the real structural difference lies in concentration. QQQ's portfolio is heavily reliant on a handful of mega-cap tech stocks, specifically the Magnificent Seven. This is like building a basketball team entirely around one superstar player. It's thrilling when they dominate but disastrous if they stumble. SCHG, by contrast, follows a disciplined, rules-based index, the Dow Jones US Large Cap Growth. The index starts with 750 large companies and applies strict screens for consistent revenue and earnings growth. This process builds a portfolio of approximately 230 companies. Yes, SCHG still owns Apple, Microsoft, and Nvidia, but their combined weight doesn't dominate the fund. In QQQ, those leaders can take up nearly half the fund's assets. In SCHG, the influence is spread across multiple key sectors. Technology leads with about 48% of the fund. However, significant allocations are also dedicated to communication services, consumer cyclicals, healthcare, and financials. This broader roster is designed to maintain growth exposure while creating a cushion against sector-specific shocks. Structure only matters if it translates into performance. While QQQ may deliver a flashier, higher peak in a raging bull market led by tech, SCHG is often a more consistent player. Historically, SCHG has shown stronger returns over 3- and 5-year periods than QQQ during certain market cycles. The most critical factor is volatility, and this is where SCHG truly shines. SCHG's standard deviation is noticeably lower than its tech-heavy peers. Lower volatility means less day-to-day whiplash and smaller drawdowns during market dips. Avoiding the deepest troughs is the secret to effective compounding over the long run. Investors who stay calm and invested during market downturns, rather than panic selling, always win the long game. Now, let's talk about fitting this into your long-term plan. If this detailed breakdown is helping you make a better investing decision, please hit the like button. It helps the channel reach more disciplined investors just like you. SCHG doesn't have to replace your current ETFs, it can balance them. For a younger investor seeking aggressive growth with a side of stability, SCHG is the perfect core anchor. You can pair it with a small allocation to a pure play fund like VGT for added high-octane punch. For someone closer to retirement, SCHG serves as a stabilizing growth sleeve. It allows them to keep pace with inflation without the stomach-churning volatility of concentrated tech. You can easily integrate SCHG into a simple 3-bucket structure: a broad index, VTI, a growth sleeve, SCHG, and a value, dividend sleeve, SCHD. SCHG's strength isn't about being the fastest sprinter, it's about being the most reliable marathon runner. It offers broad large-cap growth exposure with industry-leading low fees. It captures innovation across the economy, not just in one sector. This balance is what allows investors to remain disciplined and let compounding work its magic without constantly second-guessing their choices. Take a moment now to review your growth strategy. A lower fee, diversified option like SCHG might be the core foundation your portfolio is missing. Tell me your growth tickers in the comments below.